So moving back to this chapter. Any questions so far? Is it kind of making sense? Okay? Guys, I keep telling you this, but the first 4 chapters are the most challenging. After that, everything is just building on what we've already talked about. Our debits, our credits, our accruals, all that, that's really the core stuff. And this is all just adding to the details of what gets put into inventory, how you account for sales, okay? So there are, we encourage people to take those discounts or those credit discounts so they pay their balances. Now, we can find out on the seller side, we want to find out who takes advantage of these sales discounts, okay? So from the seller standpoint, we're going to get more insight or information. We're not going to just reduce our sales revenue. We want to find out who's benefited from these sales discounts. So we are going to show the breakdown of sales revenue. We're going to see how many sales get returned, and we're going to see our discount. It all is going to end up to be the same figures, but by giving us all this detail, we can take into account how many people are really using the sales discounts, what's getting returned, who's returning it. Do you see how this information can be valuable for businesses? To see why is it getting returned? Is it the same type? Who's taking advantage of the discounts? Is it worth it for us to do this? So from the seller standpoint, we're adding a couple new accounts. We're going to talk about the sales discount, which basically nets it all out anyway, but it helps us to see what's going on. Here's an example. Assume Sock Stereo pays the balance due of $3,500, the gross invoice of $3,800 less what it returned, and on May 14th, the last day of the discount period. We're going to prepare the journal entry that PW Audio Supply, the seller, has on its books. So we're going to show our accounts receivable to be $3,500. We're reducing that. We're going to show what's called a sales discount of $70, and we're bringing in the cash of $3,430. So do you see how our accounts receivable is going to wipe out our books, the $3,500? But we're also going to show how much of that sales revenue was offset because they took advantage of the discount, okay? So just know that this is just giving them more information to make decisions. Now, in this chapter, the key is learning what's called a multi-step income statement. But before we talk about that, there's a single step statement. The single step statement is pretty easy. We're just going to show our revenue, show our expenses. So the single step income statement, as you can see here, just shows all of our net sales, other revenues, and then it shows all of our expenses. So the single step just breaks down revenues in one lump, expenses in one lump. It's that easy. But guys, you're not going to even have to do a single step. You know, I'm not focused on that. The key for this chapter is the multi-step. So the multi-step is important because it breaks down a couple pieces here, categories. It gives us our gross profit. The gross profit is net sales less cost of goods sold. I promise you, you will see that again. What makes up the gross profit? Sales minus cost of goods sold, or net sales minus cost of goods sold. Then you've got these things called operating expenses. Operating expenses are, I don't want to confuse you, but they're basically period expenses. Expenses that occur in that normal operating period or cycle. Then you've got something called other, which comes up with income from operations, from what you're really in business to do. Then you've got these other types of revenues and losses that bring you down to your net income. But the focus on the multiple step income statement is it provides you with gross profit, income from operations, and then net income, okay? Again, the key here is what is gross profit? And then income from operations, think about it. Target is in business to sell goods. So income from operations would be all the expenses, revenue, and then the expenses related to their normal course of business. Now, other revenues and gains or losses, I bet you any money they are going to have major ass lawsuits because of their credit card scandals. My guess is, and please hear me, I don't know this, but my guess is, you see this other losses and expenses? I have a feeling they're going to have some serious losses to do with all their credit card scandals. That's not going to necessarily be in their normal operating expenses. It's going to be other lawsuit losses, which are going to then give them their net income. Do you understand what the difference is? Other operating expenses relate to the salaries, running the stores, doing everything they normally do to keep things going. But then they might have unique situations because they sell specific property or they do something extraordinary that comes in down here at the bottom. So the key here is the gross profit and income from operations that I want you to focus on. Items here, your sales revenues, less your sales returns and allowances or discounts give you what's called your net sales. Then your net sales minus your cost of goods sold give you the gross profit. Then you've got all these various operating expenses, just normal expenses in running the business. Then you've got these non-operating activities, interest revenue, gain on disposal of plant assets, maybe certain interest expense, casualties. My guess is when British Petroleum had that huge oil spill, it was down here, okay? It wasn't just a normal part in operating. So basically, this is the focus I want you to stay put on is the gross profit and then the various operating expenses. Okay. The multiple step income statement for a merchandiser shows each of the following features except gross profit, cost of goods sold, a sales revenue section, or an investing activities section. What sounds out of line there? D. Determining the cost of goods sold under a periodic system. Basically, when we're dealing with a periodic system, we are going to count our ending inventory, therefore we're going to plug in our cost of goods sold. So let's look at this example. Aerosmith Company's accounting records show the following at the year end. We've got purchase discounts, purchases, ending inventory, freight in, beginning inventory. Assume Aerosmith uses the periodic system, compute the cost of goods purchased and the cost of goods sold. So we're going to start with beginning inventory. We always start with beginning inventory, okay? Even if it's zero, we're going to start with beginning inventory. Then we're going to add purchases of $162.5. Then we're going to show purchase returns and allowances of $5,200. We're going to subtract that. Then we're going to take into account discounts. Then we have to add our freight in. Then it tells us everything that's available for sale. But then they tell us what our ending inventory is, don't they? So we take all these figures. If we subtract from that our ending inventory, that's how we determine our cost of goods sold. Really, guys, it's adding and subtracting all the pieces of inventory, but the key with the periodic is we plug it in. We find out what the ending inventory is to determine what the cost of goods are. So it's nothing real miraculous, it's just a plug-in, okay? And my goal in this chapter isn't to try to freak you out on that. I'd rather you learn it the perpetual method. Do you get what I'm saying? But I want you to understand It's not as though you can try to calculate the cost of goods in the periodic. You're going to plug it in because you don't keep track of it. But we're going to count that ending inventory. That's how we're going to keep track of it. Gross profit rate can be expressed as a percentage. I'm so sorry. My daughter wants sushi tonight. One sec. I apologize, guys. I haven't seen her this is my other daughter. Okay, so here's an example. Basically, the gross profit rate is taking your gross profit, dividing it by net sales. So REI's gross profit rate is different from DICK's or the industry average. So here you can see the gross profit, which is, remember, sales minus cost of goods sold equals gross profit. Okay? REI's is 43%. But look at DICK's, it's 30%. I wonder why. It's bugging me. I gotta now find out. Well, how does REI compare to its competitors? Its profit margin was lower than DICK's in 2010 and was less than the industry average. Thus, its profit margin does not suggest exceptional profitability. Well, then why profit? Gross profit rate. REI's profit rate differs so much from DICK's. Oh. Okay. So basically what they're saying is however they do this, what REI's gross profit is on selling the products is high, but yet all the other costs that make up their profit margin ratio is a lot higher than they're robbing it from one place and putting it somewhere else is basically. Never mind. So the key here is recording merchandise transactions, okay? Recording purchases of merchandise using the periodic system. Periodic system means we don't keep track of it all the time. On the basis of the sales invoice and receipt of the merchandise ordered from PW Audio Supply, SOC Stereo records the 3,800 purchases as follows. We show purchases of 3,800 and accounts payable of 3,800. This isn't using the perpetual method. This is using the periodic method, okay? Am I confusing you guys with the two different ones? Perpetual method is you're always keeping track and you always know where your inventory and cost of goods are. The periodic method is you plug it in at the end of the year. So in doing that, when you purchase goods, you show it as a purchase and accounts payable. You add the freight, you put it in as freight in. All of these are part of your inventory. Then when goods get returned, purchase returns and allowances. On May 14th, SOC pays the balance due with the 2% discount. We're showing the discounts. PW Audio Supply records the sale of 3,800 of merchandise to SOC on May 4th. This is again under the periodic. No entry is recorded for cost of goods sold at this time. That's correct because we don't know what that exact cost is. So we show the accounts receivable and sales revenue. We'll show returning goods. On May 14th, PW Audio Supply receives payment of the $34.30 from SOC. So we'll show the cash with the discounts. So what they're trying to help you see here is when we're dealing with the periodic inventory system, we're going to record things a little differently than when we're using the perpetual system. Do you see how everything goes into inventory or comes out of inventory? But when we're using what's called the periodic system, we're showing the purchases, we're showing the freight in, we're showing purchase returns and allowances and discounts. So instead of everything being treated as inventory under the perpetual system here, we've got different it's ultimately going to go into inventory, but we're treating it differently. This is an important slide just to keep track of the differences, okay? Then, the difference here is under the periodic system, we don't do anything with inventory till the end of the year, or show our cost of goods sold till the end of the year. You see how that's no entry here? So let's see here. I told you I'm not going to deal with IFRS in this. Okay, good. So let's go over some problems. I don't want to confuse you by periodic versus perpetual, but I want you to understand just some key differences in it, okay? Let's go over some problems. Are we good? Do you see how actually, guys, is this overwhelming or does it kind of fit in and make some sense? The hardest were those first couple chapters. How many of you guys are still confused about debits and credits? What's a debit?
Left.
Oh, I love it. What's a credit? Does a debit always mean increase? No. It means increase depending on what kind of account it is, or decrease, right? So what is the normal balance of assets? What's the normal balance of liabilities? Like, I could jump. Except I twisted my ankle, so I don't want to jump again. That is the key to this class. I'm telling you, that is the hardest thing for people to get. Debits and credits, left and right. It's not up, increase, or decrease. It depends on the account. Make sense? Yes? How are you doing, guys?
Tired.
Do we want to do a problem or two, or do we want to start on Wednesday with some problems, take a group quiz on Chapter 5, and then Chapter 6, you guys are on your own with your quiz?
Let's do that.
Tell me.
The second one sounded pretty nice.
The second what?
The
Second idea?
English.
You know, again, I'm not trying to be a wuss with these group quizzes, but it's kind of easy when there are just 8 of us. Do you know what I'm saying? And thank you for showing up. If everyone shows up, you're part of the group quiz. If you don't show up, you have to take it on your own. Does that motivate you? Now, I won't have pizza next week. I will, or on Wednesday. I might have it on Monday again, but not Wednesday. So you're on your own for food, okay? But still come. We'll go over some of these problems, and then we'll take a group quiz. And honestly, guys, we'll probably do some multiple choice like we did. Again, I keep telling you, it's not to trick you, it's to help you learn, okay? Yes?
So the homework is, for chapter 4 will be due on Wednesday, and then the homework for chapter 5.
Due on Monday.
Okay.
Is that okay with you guys? And I already have the solutions on there, and you know what your homework is, why? Because it's in the syllabus, right? Groovy, guys. Okay, and does 6 o'clock work great for everyone?
Works for me.
I mean, it's great for me. If anyone wanted to do 5:30, I can do that, but we're counting on 6. That's what time the class is. Is that okay?
Yep.
See you guys.